If you don't understand market structure, you're not really trading, you're just guessing. Every move the market makes is part of a bigger story, and once you learn to read that story, you stop chasing candles and start predicting them. Today, I'm going to break down market structure so clearly that by the end of this video, you'll see the charts in a completely different way, and the market will finally start making sense. Let's start with the basics. What exactly is market structure? It's simply how price moves and organizes itself on the chart. Think of it as the skeleton of the market, the framework that holds everything together before you add any indicators. Once you understand how to read that structure, you can trade confidently, even on a naked chart. The market structure is made up of three main phases. The first one is an uptrend. This is where price keeps making higher highs and higher lows. At the bottom of the structure, we have our lows. Here's how it works. At the top of the structure, we have our highs. The first high is our starting point. If the next high forms above it, that's a higher high. Then if the third high forms above the second, that's another higher high, because each one is higher than the last. If a low forms higher than the previous low, we call it a higher low. And if the next low is again higher than the last, that's another higher low. This pattern, higher highs and higher lows, is what keeps the uptrend alive. The moment that pattern breaks, the market might be telling us it's ready to slow down or reverse. I know it might sound like a bit of a tongue twister, but once you see it on a chart, it clicks, and that's when you start spotting trends like a pro. Next up, we have a downtrend, where price keeps making lower highs and lower lows. Here's how it works. At the top of the structure, a lower high forms when the market fails to reach the height of the previous high. Each new high is lower than the last, showing weakness in the move upward. At the bottom, a lower low forms when the market pushes down past the previous low. Each new low is lower than the one before it, showing the sellers are still in control. When you see a sequence of lower highs and lower lows, that's the market stepping down the stairs. And until that pattern breaks, the trend is likely to keep moving downward. Lastly, we've got consolidation. This is when price moves sideways, almost like it's taking a break. During consolidation, the market isn't making clear higher highs or lower lows. Instead, price is bouncing between a support level at the bottom and a resistance level at the top. Think of it like the market is trapped in a box. Buyers push it up, sellers push it down, but neither side is strong enough to break out yet. This phase is important because it's often where the market is building pressure for the next big move. When that box finally breaks, either up or down, the move can be explosive. Traders who can spot consolidation and position themselves for the breakout have a huge advantage. But here's the thing, consolidation can fake you out. Sometimes the market pretends to break out, only to snap back inside the range. That's why reading market structure as a whole, not just one phase, is key. So now that we understand the three main phases of market structure, you might be wondering, how can we actually use this knowledge combined with price patterns to make smart trades and hopefully turn a profit? I almost want to say it's simple, but in reality, it's not. Trading is a skill that takes time to develop, and mastering market structure takes practice, and then even more practice. But stick with me, because once you get this down, you'll be way ahead of most traders who just chase the price blindly. Let's break it down using an uptrend as an example. Picture this. The price is making a strong move upward, what we call a leg up. Now, what's really important here is how price behaves as it approaches the upper boundary of the trend channel or trend line. If the channel is wide, meaning price has room to move between support and resistance, and you want to capitalize on smaller, more frequent moves inside that range, here's what you need to watch for. First, remember this. In a bullish market, it's generally not recommended to short sell or sell against the trend, unless you have a very clear reason and strong confirmation. Going against the trend can be costly if you don't know what you're doing. However, if price reaches the upper trend line and forms a recognizable pattern, like a zigzag retracement or correction, this can signal a potential short-term sell opportunity. This zigzag pattern shows the market hesitating or pulling back slightly before it possibly continues the trend or reverses. On the flip side, if price moves down toward the lower trend line and forms the same kind of zigzag pattern, that's your cue to look for buying opportunities. It means the market is likely preparing to continue the uptrend after a brief pause. This concept is formally called a continuation pattern. It tells us that the market isn't done moving in the original direction yet. It's just taking a breather. By recognizing these patterns in the context of market structure, you can time your entries more precisely and manage risk better. Now, I know this can sound a bit overwhelming when you're hearing it all at once. That's totally normal. But don't worry. In the next part, we're going to jump into backtesting some real historical charts together. I'll show you how these patterns have played out before and how you can spot them yourself. Seeing this in action is what really cements the understanding. So get ready, because once you start combining market structure with pattern recognition, your trading decisions will move from guesswork to calculated moves backed by solid analysis. All right, I've already covered these patterns in the previous video, so if you're familiar with them, great. Now let's take a step back and dive deeper by looking at a real chart to see how this all plays out in practice. Here's a clear example of a bullish market structure that formed a really clean pattern. The moment I see this, I'm already on alert for buying opportunities. But here's the crucial part. I don't just jump in anywhere. I'm looking for very specific clues that confirm the strength and reliability of the move. Look closely. We have this initial low, followed by a second low that's slightly lower, and then a third low, making it 3 lows in total. This sequence helps me understand the market's rhythm and potential liquidity areas. Now, if you glance just to the left, you'll spot a previous low. This acts as a liquidity grab point. Essentially, the market dips down here to shake out weaker hands and trigger stop losses. This move sucks in liquidity, which big players need before pushing price higher. And that's exactly what happens. After grabbing liquidity, price aggressively pushes upwards with strong momentum. This isn't just random noise. It's a calculated move by smart money to fuel the next leg up. From here, the smart trader's move is to flow with the trend. As price rallies, you'll start noticing bullish continuation patterns, those zigzags, pullbacks, or small consolidations, popping up consistently. Each one is like a second chance, a new opportunity to scale into your buy position. What does this mean for you? It means you don't need to stress about catching the absolute bottom or perfect entry. Even if you miss the first move, the market will offer multiple pullbacks or re-entry points. You can add to your position steadily, maximizing your profits as the trend continues. As you follow the chart further, you'll see these patterns repeatedly forming. This isn't luck, it's the market's natural behavior. The more you understand what to look for, the better you'll get at recognizing these setups in real time. This repetition is the trader's edge, the ability to anticipate where the market will pause, where it will gather momentum, and when to jump in. So, don't get discouraged if you don't nail the first entry. Instead, focus on mastering the pattern recognition and scaling strategy to build consistent profits. All right, that wraps up this deep dive into market structure and how to apply it with real patterns on the charts. Remember, trading isn't about luck. It's about understanding the market's rhythm and using that knowledge to make smarter decisions. Keep practicing spotting these patterns and phases, and you'll start seeing the market in a whole new way. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you don't miss the next one where we'll break down even more strategies to help you trade smarter. Thanks for watching. I'll see you in the next video.